Welcome to the Private Lender Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by HardMoneyMastermind.com.
Hey everyone, thanks for checking out the Private Lenders Podcast. Chris and Jason here as always, and we have a special guest, Derek Dombeck from Best REI Funding. Derek, how you doing? Thanks for being with us.
I'm doing great, guys. Thanks for having me.
Absolutely. No, we appreciate you taking the time. So yeah, just a little background. Like we've known Derek and his partner Jeff for probably 4 or 5 years now.
Yeah, I think it's somewhere in there.
Yeah, and you guys have done a good bit of growth, especially recently, and we're going to dive into all that. If you wouldn't mind, just to get started, would you let everyone know a little bit about your background and business and where you're located and what you guys do?
Yeah, so primarily the bulk of our business is in the state of Wisconsin. We're based out of Green Bay, Wisconsin, and Jeff and I became business partners about 10 years ago, but both he and I had started in the early 2000s. And we started like most, buying fixer-upper properties, flippers, rentals, stuff like that. And when we met and became business partners, he had already been dabbling in lending. I had no background in it whatsoever. But we were raising private money to fund our own flips and our own real estate deals. And over time, as we go through this discussion, you'll see how that grew into what we are today. But the big thing I learned when I met Jeff, because I came from a background of using banks for everything, which bit me in the ass hard in 2007. Mm-hmm. So, getting into the private space and dealing with real people has been the main focus to grow Best REI Funding.
So do you think Jeff originally was attracted to lending and then you, just because, the amount of work that goes into doing a fix and flip or buying a piece of real estate or owning an asset. And that's not to say that it can't be more profitable dollar for dollar, mm-hmm. But do you think he and you wanted to transition into the private lending sector? Because it's like, you know what, we can leverage our time. Maybe we won't make as much money per transaction, but it'll be less risky and we can do more volume.
I think it's twofold. Part of it, I came from a construction background, so it was really natural for me to take on real estate flips and projects like that. Jeff has an IT background, so he's always sat behind a computer and where I would be on a job site getting my hands dirty, he would have hired out everything, and it was a shift in mindset for both of us, and we did a lot of flips together. But while we were doing that, I think because he already had the background in lending and he had never used a bank for any real estate investment ever, which took me a while to really probably acknowledge that or see how great that was, because I didn't necessarily believe it. We could build something big enough to sustain at that time just ourselves and our families. We didn't have staff. But as competition grew, so 2012, 13, 14, more and more people were getting into flipping in our area and harder and harder to find deals. And everybody's common thread was we can't find money. But Jeff and I didn't have that problem. We had more money available than we had deals to put it into. So it organically grew. We didn't really focus on it until about the time we met, Chris. Jason a little bit, but about the time we met Chris, that's when things really started to rock and roll, right?
Yeah, as I recall, when you guys came down for training with us, you're already well into business, had done a lot of deals, and had maybe 10 million, 15 million outstanding, something like that, which
we were at about doubled. 5 to 6 million when we came out to meet up with you guys.
Okay, and you're probably 4 or 5x that now.
Yeah, and we've had aspirations to get to 10. Like we thought 10 would be some huge milestone, and now we look at that, and if it was only 10, we'd be freaking out a little bit.
So 10's good, but 20 something's better.
10's a big first milestone goal that seems unapproachable.
No,
and here's the thing, Chris and I talk about this all the time because we've had in the $40-45 million deployed here for a long time, and you look back and you don't want to say it's easy because it was a lot of hard work over the years, and it certainly was, but the snowball grows. capital grows, your relationships, your resources grow. When you're looking at the other way from the beginning, it's like, how am I going to do this? How am I going to raise $1 million? That's so much money. Or how am I going to raise $4 million or $5 million? Like, you look at it and it's a humongous kind of what you believe to be as an uphill battle. And then, hey, it's just block and tackle over and over and over and over and over and over. And then yada, yada, yada. A few years later, it turns into a big machine.
Well, and the big challenge is playing that teeter-totter. Like, how much money do you have available versus how many applications
100%.
coming in?
Mm-hmm.
And do you go and raise, and then you can't put that money on the street? Well, that's not good. Like, we've had that battle, up until recently. We're in a much better position now, but we're always raising money. That'll never end for us, I don't believe, because in our market, we've got a lot of room for growth, and we want that growth as long as it's controlled growth. So we are always looking to raise more money. But then when you have, let's say, a month where your applications are down, you start getting second thoughts, right? You're like, oh shit, I just raised another 5 million. Can I really place that in the next 60, 90 days?
I mean, I don't think that there's anything wrong with raising capital actively and keeping it on the sideline. Because,
right.
Like, that growth could come or maybe not. Nobody gets hurt, right? Like, don't like take it into your account and be like, all right, I got to deploy this within 90 days, because that's not the right way to do it. But we always have money on the sideline. Everybody knows the deal. I don't think there's anything wrong with it. And I think it's great to be prepared for when that growth does come, or that, like, $1 million or $2 million commercial deal comes along, or, like, good to have it there. Let me ask you a question, if you wouldn't mind, kind of pivoting to the other side. Where are most of your leads and your actual loans coming from? Like, what kind of marketing channels have produced this growth?
Chris, you're going to be so shocked at our genius marketing. We do zero marketing. So everything that we do, and I say zero, which really means we're out there in front of the REIA meetings and we're educating people. So that is marketing. But
it's not zero. That's marketing.
It's all referral business.
Okay.
Everything that we're doing to date is referral business. Now, because we want growth, we are starting to implement some marketing plans. And, for example, yesterday I had a conversation with a good friend of mine. We're going to start a mailing campaign. We're going to start some social media campaigns. But to do what our average month is, 20 to 25 loans, $3 to $4 million a month. That's up until now been all us in front of the room, and at 8 different REIAs across the state of Wisconsin, and referral business.
And are you guys going to those yourselves, both you and Jeff?
So we typically kind of, he'll take one or two, I'll take one or two. We just go back and forth depending on our schedules. And if we can't make it, we'll send a representative from our company. But it's somebody in person from Best REI Funding.
And do you guys hit your email list? Do you have an email list that you're actively? Because that's the lowest hanging fruit.
We don't hit it that much. Not like we should. I mean, that we have got this growth in spite of ourselves, not because of our awesome marketing, right? Like, there is definitely things we could be doing better. And that would probably be number one, because it's so easy. It's close to free. Like, you pay for a software, but it's in essence free. I'm sure you have a ton of email addresses from the people you've lent to and the people who have just inquired about loans over the past, 10 years plus. Like, that's low hanging fruit. That's easy money right there, in my opinion. We do stay in touch with them, but we don't have a campaign that goes out every 14 days like clockwork, and that's something that it's interesting, because we talked about, or talking about staff or things, like when Jeff and I were just by ourselves running a full-time real estate acquisition company, and then the lending company was really getting to the point where it was full-time. So he was in the lending company, I was in the real estate company. I mean, we work together, but he kind of manages and oversees that more so. And getting to the point where we said, okay, we need to hire staff, and didn't want to have employees, didn't want to have the overhead. And now there's no way we could do it without staff, nor would we want to.
We'll totally agree with that one. A couple questions on that, because I am always curious about people's operations and what they look like. What was your first hire, and what does your team look like now?
First hire was a family member of Jeff's. which I was on the fence on that one. And just because I'm not a big fan of hiring family. But she became probably more invested in the success of our company than we were. Like very passionate about making sure things are done right.
What was her position? What did her position look
she
like?
was essentially, at that time when we first hired her, she was doing everything. She was taking, calls from clients. She was doing the bulk of the underwriting, but that was back probably right after we came out to Baltimore, maybe 6 months or a year after we came out to Baltimore. So again, at that point, we were doing 4 or 5 loans a month. It was, everything was still on spreadsheets. Everything was having to be keyed in. The biggest takeaway, I was talking to Jason the other day about this when we came out to hang out with you guys. Jeff being, an IT geek, the biggest takeaway, we left your place, and he's like, I can't believe they do all of this at that time with Google Docs and Google Sheets. Like he was trying to overcomplicate everything.
Oh, on the origination side, the stuff that we do on the origination
side,
and file storage, all that.
When Jen first came on, she really was, she was keying everything in. She was, drafting all the paperwork and proofreading everything and dealing with the title companies and dealing with the clients. And, now fast forward to current, we've got, I think we have a staff of 6 people within the United States and 3 VAs in the Philippines, plus Jeff and myself, plus a couple of real estate brokers that we get, BPOs from to compare with my BPOs, because I do all the BPOs for every loan because I'm kind of a control freak that way.
Valuations are important.
Right, but I want a second opinion, especially when we're doing things in markets that I'm not familiar with every back street,
Yeah, we talk about that a lot. I mean, you also want kind of a third party independent valuation if you're taking on private capital, just to be like, hey, this, we don't just believe the value is this does as well. So most of your loans are coming in from repeat borrowers and from referrals. A lot of people probably know you in the state of Wisconsin. When I spoke to you earlier, you're like, hey, we're trying to, I was still surprised you were only lending in Wisconsin just because the amount of volume that you're doing. And that just goes to show that there's a lot of volume out there, and there has been, there has been for a while. But so let's say whatever, you do a loan for Bob Smith, and Bob Smith tells his buddy and says, hey, hit up these guys at Best REI Funding. They'll help you out. When they call, who's fielding that? Who's running those leads?
So we have 3 people specifically taking those calls, and Jennifer is our original, hire. She's the first one, and she kind of oversees the other 2. And so they're taking the inbound phone call and they're doing the interview, which Jeff and I used to do.
Sure.
And trying to get through the original questions, all the typical questions that every borrower has, especially if they're a newbie borrower. Once it gets past that, they go, our application process is completely on our website. So they fill out the application, or if they had already filled out the application, that kicks an email out, and one of those 3 people instantly reach out to that applicant. So typically, unless they fill out an application outside of business hours, they're getting a phone call within 5 minutes.
Sure. Which they should. Like, that's
definitely
what has to happen, and that a lot of people don't know.
Okay.
What do you think your closing ratio is compared to applications? So to us, a lead is anybody who inquires about a deal, like even if they're no matter what. So, and you might not know this off the top of your head. I'm just curious, like based on how many applications you're getting, how many of those deals are you closing?
Yeah, and I'm going to make the numbers up because you guys won't know if I'm full of shit or not. So I'm going to say we're probably getting 35 to 40 applications or leads to close 25 loans. And some of those get kicked out in underwriting, right? Like because the deals suck. But
so like half of them, you think?
Oh, we're doing better than half.
I mean, that's a high number. That's a high
It's a
closing
very
rate.
high number.
Yeah. But I think the reason for that is, again, we're out there educating our borrowers. So, we're talking to them at REIAs, we're talking to them at other events where we might have weeded out a lot of the tire kicker applications because they never even submitted or they never even called because they heard us at a meeting or they talked to one of us at a meeting, right? So I think that's why our leads are better than if we were just out there on Google or sending out mailers and people were calling in. They're going to have a lot more questions. They don't know us at all.
Sure.
If they're being referred in, they've got a lot of their answers from the person that referred them, right? So I think that's probably why it is that way.
Interesting. Good to know. And you're at what, 12-4, 13-3?
The other way around, 13-4, which covers the Milwaukee metro area, and then 12-3 across the rest of the state.
And 12-3 across the rest of it. Do you know approximately down payments, cash to closes, things like that? I remember what your formula was back in the day, but I don't know if that changed.
It hasn't changed much. So we still will go 70% of after repair value, and we will let them come zero money out of pocket if they can get a good enough deal.
If they can get a good enough deal. I remember you were okay with it as long as you were willing to take back the property and it was at the numbers you wanted.
That's still true. I mean, I still won't lend on something I wouldn't want to own. And
sure.
We moved into the Milwaukee market, and there is a lot of duplexes and stuff that I wouldn't necessarily want to own, but I know I could get rid of it quickly if we had to take them back. But I mean, guys, we're still in 10 years of lending. We are on foreclosure number 9 right now.
Sure. So one a year, or just less than one a year.
So I mean, we're not that we haven't had plenty of deals that we had to work out, and there's been other defaults, but we worked them out.
When you say foreclosure, do you mean actually end up owning the property? I
mean having to go through the entire foreclosure process.
And like if you sell it at auction sale, foreclosure auction, you would count that as a foreclosure.
Right. We've had some that we took, but they just signed the deed back in lieu of foreclosure. We've had others that we did workouts, but for the most part, our default rate is extremely low. Mm-hmm. And again, I attest that to all the time we spend educating our borrowers on the front end.
Sure.
Yeah, and just about borrower quality. Like if you have high quality investors, they don't, even if they do go a little sideways on a project, they know how to work it out. And we've found that even if you have very conservative underwriting, if you have a less skilled operator, they don't know how to work out a situation that went sideways. They just kind of throw their hands up and they're like, I don't know what to do.
Do you guys lend to newbies at all?
We do lend to newbies. Jay, you can take that one. I know you.
Yeah, I mean, our model and our formula is a little bit different. We're massive marketing on the front end, so we get honestly that many leads a day, mm-hmm. Right, to close one of them. Because we close about one deal
per office. Per office is probably 30 a day.
So so
it's a grind.
Yeah. So our teams that our partners, employees that we have in place, they're spending a lot of time on the origination side. By the time something goes into underwriting, typically it's done. Typically it's going to close unless there's a major title issue or, mm-hmm. Something happened. But we spend a lot of time on the front end, so it's a little bit different. But on our mind, in our model, the borrowers are bringing a good amount of cash to the table, right? They're bringing a lot of cash to the table, and that's also why our closing rate's very low compared to the amount of leads and deal flow we get, because someone might be nipping at the bud and be like, hey, yeah, I'm in, let's go. Whatever it takes, I'll go, whatever it costs. But that doesn't mean that they're going to have the cash to close to work with us to begin with. So, we'll work with newbies. Ideally, this sounds crazy, but our borrowers are bringing at least 30% cash to close on every deal, sometimes more, sometimes 40%, sometimes more, depending on the situation. So, we're looking at everything, let's assume the collateral is good. We're looking at everything between character, capacity, and credit, and making a decision off that of how much leverage we want to give them or not give them. Mm-hmm. But again,
what's your default rate on those, Jason?
Similar to yours. Your default and our default are about the same. It's kind of it's interesting because it's a little bit different of a model. Like you're very vested into one geographical area that you know really, 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 really well. You're willing to take over it. Chris and I don't want to take over anything, right? Like that property's got to sell at foreclosure sale if it gets to that far.
Which we never get that far.
Yeah, because typically don't get that far because they work themselves out. But like we don't want defaults. We don't want to own the properties. We sold our entire rental portfolio a few years ago. So that's not our model. I know a lot of people, Derek, like your model. A lot of people that we know personally inside the Hard Money Mastermind group do it similar to yours. I don't think they do it at scale as you, but they do it. You know, they've got like a few $1,000,000 of their own money deployed, and they're like, hey, I am willing to, any property I do a loan on, I'm willing to take back and take ownership myself.
And they also lend to the same people over and over. They know how they operate. They give them a higher leverage, and they just, have like a couple dozen people that they lend to here and there. It works fine. We know people here around DC like that.
And that's kind of what we do too. I mean, if it's a newbie, they have to have a partner or a mentor that we approve. So we force that on them, or we don't give them the loan. And that partner may or may not personally guarantee the loan. It's case by case. But same thing, once we have that repeat client and we know what they do and how well their work, or the quality work that they do, it's going to change. But the big difference for us is I still run a full-time real estate acquisition company. So it does not bother us in the least to take over a property.
Sure.
We're just going to take it from one business and hand it to the other. Yeah. And I'm going to send my project manager out there and we're going to get it done. So that's also been beneficial because I can sit there and say to a client, I know exactly what you feel. I know exactly what you're going through, the material shortages, the labor shortages, blah, 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 because we're still in the trenches with you. And that we get a lot of great feedback on that aspect of our business. Because you know how a lot of people feel like they go to the bank and the banker's sitting there with his suit and tie looking down his nose at people. And I pointed out, I'm like, we're no different than you. We just happen to have some extra money that we want to lend you so you can go and do a deal. Right?
I like that spiel. I like that a lot.
Do you think in your model you could do it as a JV model? And is that receptive to clients, or you guys just want your predictable return? I mean, we don't do JVs. No, I'm just curious on yours.
I do some here and there. I mean, it's very, very case by case. I did one this year with somebody that I really enjoyed. I mean, it was a good project. We did well. He was newer in the business, and I actually wholesaled the house to him and then offered him the loan, and it had foundation issues, and he didn't want to tackle that without some experience. So I triple dipped on that one. We wholesaled it, got the loan, and then got half of the sale price when it was done.
You know what else is probably an interesting thing to point out to everybody listening and watching is I think the models change depending on what geographic area and what market you're in. I mean, I'll tell you that we'll typically do 65% of the after repair value and then 70 to 80% of the purchase price plus construction costs, plus 100% of the construction costs. That's typically where we come in at. Mm-hmm. But let's just say we did 65% of the after repair value. It's very rare. It's very rare that a deal we're doing or a client that we're doing a loan for is finding deals at those numbers in our market. That's not to state that they don't exist. They do. I've seen them, but it's not the, it doesn't happen often. And I think depending on where people are, if they're on the coast or the Midwest, depending on what part of the country they are, will dictate and depend the market. One other quick question, then you can jump in on that related to your setup. Let's say a real estate investor doesn't buy a great deal. They're not buying a great deal, but you don't think it's a great deal, but they think it's a great deal because they're gonna do a buy to rent, and to them the rate and return still makes sense. And let's say they have a good amount of money and they're willing to put like 40% down. Like even if you don't think it's a good deal for them, would you still do it with a substantial down payment?
After a very hard conversation with them, just telling them exactly why I feel the valuation isn't there and why I don't think they should do the deal. If they still wanted to do it, yes, I would do the loan.
Sure. I mean, it's not uncommon for you to think it's going to exit at 300 and they see 350. Like it happens all the time. And sometimes they're right.
Yeah.
Sometimes they're right because we're like conservative by nature,
Yep. That happens daily. I mean, I was just doing a couple BPOs before I got on this, call with you guys. And yeah, everybody has this pie in the sky, especially right now as the market is having some turmoil.
Mhm.
I'm not going to be looking at it and saying, well, okay, I'm going to give you the highest comp possible, because we all know there's some changes in the market that are happening. So yeah, they always want the highest value. I always want not the lowest, but I'm much more conservative. And so yes, Jason, they do have to bring money to the table in almost every closing. I mean, if somebody gets a smoking hot deal, will we let them come in, no money out of their pocket? We will, but it has not been that often, especially in the last 12 to 24 months.
For sure. A couple more questions. I had made some notes here. I wanted to go back real quick to your team. Out of curiosity, what do your VAs do? What are your virtual assistants doing? There's 3 of them. What do they handle?
So we have one that is primarily, she's answering our phones and then directing calls. So we stopped letting any call go to voicemail. So we want somebody answering those phones live, no matter what.
Oh,
and then she is doing a lot of the coordinating with the title companies. The other 2 VAs, which are under her, so she has to oversee them. And because I don't deal with those VAs, I don't know exact hours they're all working. The other 2 might be part-time. Sure. But so they're doing verifications on, the people, on the entities, making sure they're in good standing with their LLCs or whatever entity they have, doing flood searches, doing, the insurance, just pushing all the paper.
Got
basically.
it. Yeah, like the loan processing type stuff.
Yeah. Yep.
Cool. All right. I want to move through a couple more things I have here. Where do you see best REI funding? What do you think it'll look like in 5 years? Assuming there's no crazy economic, recession and all that stuff.
Without leaving the state of Wisconsin, Jeff and I are fairly confident we could get to 100 million a year in originations.
Wow. In Wisconsin.
In Wisconsin.
That is a big number.
And it's interesting how the mindset has shifted, especially for Jeff. Jeff has always been the one that's a little more reserved and not necessarily feeling that we might be able to hit these goals. And now it's kind of flopped. Like he's thinking we could hit over 50 this year, and I don't know if we will or not. I just want to make sure that it's not growth that happens too fast, because that did happen to us about 3 years ago, and it overwhelmed our systems. It overwhelmed our staff. We didn't have enough staff, and but there's peaks and valleys. So how much growth do you want? How much overhead do you want? Versus, if we have 2 or 3 months in a row where we're at 50% of our loan volume, well, yeah, that's not going to be ideal,
Right.
And we still do something that I know you guys will likely disagree with, and most people do. We do not collect monthly payments from our clients.
Oh.
And we never have. And we had that conversation with you guys a few years ago, and everybody's like, that is stupid. How do you know if there's a problem? How do you know if they're going to default? But we like that model.
I don't think it's stupid necessarily.
For us, we keep.
Yes, it is.
I don't know.
No, I'm just kidding.
I don't know if I call it.
It's for each their own. It's whatever it is.
Yeah, it makes it different. It makes some of your, proper as long as the underwriting's good and proper expectations with your capital investors, obviously. And I'm sure that, a couple things I was thinking about as you were talking is oh, no monthly payments. Oh, I see why your closing percentage is so freaking high. Oh, the leverage and lending to the same people. I see why that closing ratio is so freaking high.
It is. And most of our investors are not looking for a monthly payout. Most of our investors are in it, retirement accounts, or, this is
money expectations that way.
They want it to accrue. They want it to, compound. So if we don't have to go through the extra work of collecting these payments and docketing these payments and everything else, it's worked out real well. Now there is still occasions where we do it, but as a general rule, we don't. And yes, that is a big selling point when somebody comes to us versus our competitor. it's a selling point.
So who's managing the back end? Like, I guess you can call it a servicer, but like, who's managing to make sure the project's kind of getting done on time and things like that? Just because, like, most of these have construction components, I'm assuming,
Yes.
right?
Yeah. So our VAs handle the draws, the draw requests, and they process the draw request. We hired Jeff's brother, who was he used to be in corporate America doing some stupid shit, and so we hired him, got him out of corporate America. So he's on the back end. He's auditing everything. We use Mortgage Automator now as a software. So he's the one that releases the funds. The VA will push all the paperwork through for the draw request. But Chris is the one. Chris, Jeff, or myself are the only ones authorized to release funds. And and now we have a couple different people, but just freelance, that we've hired to go and do spot checks on these properties. And so we require every property owner to put a lockbox on the house. We have to have the code to that lockbox, and we will not schedule a walkthrough. We will show up when we feel like it, anytime we want. And we had to do that. We ended up in a fraud case. We had a guy that sucked all the money out of the escrow because he was sending us pictures from a different construction project. Mm-hmm. And it was 3 hours from home, so we weren't going down there and checking on it. And by the time we found out, it was too late. So, we learned. People are required to do video walkthroughs. They have to have a continuous video without any stops, starting with the front of the building showing the address, and then walk through the property. So they have to do monthly walkthroughs for us. So it's we've had to tweak it a little bit, but it's working.
So you do monthly walkthroughs whether they have requested a draw or not?
Yeah. Well,
that's smart.
And it depends. Like if it's a paint and carpet, we might not do one at all.
Yeah.
But we charge every one of our clients $600 for the life of their loan to pay for that service. And if they bitch about it, we just literally tell them a couple of previous clients screwed it up for everybody else, and now because they lied to us, we have to hire somebody else, and somebody has to pay that price. And then
I like that.
They're not mad at us. They're mad at some other idiot that screwed it up for them. But it takes the pressure off of us.
All right, I got one more underwriting question, and then Chris, if you have any other,
I have one final question.
Final question. That's good. Okay. What do you believe? So, the characteristics of a borrower are really important, right? In general, the communication. Who kind of on your team would you say, if anybody, is kind of signing off on the characteristics of this borrower to determine if they're going to perform? Because obviously the collateral is something you can touch, the credit you can see, the capacity with their bank accounts and shit like that. Like you can see all that, right? But that doesn't mean you can actually see them physically. Like unless you go to Zoom, unless you meet them at the property, unless you talk to them on the phone multiple times. Like, is there somebody inside your organization that you think is responsible for, hey, is this person a good human or is this person a jackass?
Yeah. And so everybody that has any interaction with that client all throughout the entire underwriting process puts their notes into the CRM, into Mortgage Automator. And there's not a loan that goes out the door that Jeff doesn't authorize. And if Jeff's not available, that I don't authorize. So we can go through and read all the notes. And those notes will say something like, Brian will have a note in there that said, tried calling, left a voicemail, no answer. 4 hours later, left another voicemail, sent a text message, client responded, said they would get us the documents tomorrow, right? Like, so we can read through these notes pretty quick. And if this person dragged out our clients for 2 weeks and then started bitching at our client because we can't close on time, but they didn't get us the docs, that's a huge red flag.
Yeah. They're not going to be able
Jeff and I look at those notes and that's happening more and more. I would say now more than ever is people are dragging out, trying to get their docs to us. And then 2 days before they're closing, they're screaming at our client, at our staff saying, well, How come it's not through BPO yet? How come it's not, at the title company? Why can't we close on time? So there's a few times that Jeff and I have to go and call a client and tell them, you're fired. We're not doing business with you. Nobody treats our staff that way, period.
Right.
And we've done it. We pulled $350,000 away from the closing table at the closing table because these were actually friends of mine, which really pisses me off. But
these are friends of yours.
They were upset with Jen because they had to personally guarantee the loan. And they were screaming at her. They were F-bombing her. And Jeff said,
if they're F-bombing an employee, they're fired.
They're out.
You're right.
No, they're out.
We
don't even allow that. And we lend in Philadelphia.
Yeah, that's just a mom talking to her daughter in Philadelphia.
Yeah,
but,
seriously. It's like, hello, good morning.
So to us, we protect our own, we protect our staff, we protect our clients, we protect our investors. We have the no assholes policy and we stick to it.
Yeah. I like it. All right. Final question from me. Well, first of all, congrats on everything. 4 or 5x since the time you were down here last. That's awesome.
Chris,
and great to hear.
We couldn't have done it without you, Chris.
Well, that leads right into my final question.
I love Derek. How I talked to him 2 days ago and he excludes me. I'm going to take myself off this video screen. Actually, you two can just have a conversation if you'd like.
We're having a little bromance here. You can leave, Jason.
I'm staying.
Rolls right into the final question, which is, are you and Jeff coming down for the mastermind in November?
I think Jeff may be able to. I don't know if I can or not.
You have something else scheduled?
Well, yeah. So long story, but I was sitting in a hot tub in Vegas a few years ago and bought a bucking bull, and now I have a bunch of them. And the first week of November is usually when we're sitting in Vegas drinking whiskey and watching bucking bulls. So I'm not
maybe
sure
I'll skip the mastermind and come out with you.
It doesn't suck, but your liver hurts after that. I'll tell you.
Makes
for
sense.
Sure.
It's Vegas.
But yeah, we certainly want to. And
yeah, you guys are always welcome. Be a great addition to the group. We're totally looking forward to the meeting, which we just announced earlier this week. Obviously for, pandemic reasons, we haven't done a big in-person thing yet for the mastermind, even though the online mastermind's been going very well. So we're excited about that. And
you guys had a pandemic? We didn't have that in Wisconsin.
Around DC Metro, we certainly did.
Yeah, we just
very noticeable.
We ignored it.
That sounds awesome. I wish I ignored 2020.
Mm-hmm.
But everything's fine now. Well, that's it for me. I totally appreciate you taking the time coming on the podcast. We'll certainly share it everywhere. I know mastermind members and podcast listeners will be, there's a lot they can learn from how you guys have grown and how you run your operation.
Chris, before you cut me off, if you don't mind, can I give your listeners
of course
free book in the future?
Oh, absolutely. Sure thing. Yeah. Let everyone know where they can find you and your stuff.
Yeah. So right now it's not out yet. I'm co-authoring one book with a bunch of other awesome people, and I'm authoring my own book, which is all about lending and all about the private lending space. And so I have no problem giving it away for free. I do need people to shoot me an email and get me their contact information. And the book is hopefully going to be out November-ish. So you can reach me at first name Derek at bestreifunding.com and just get me your name and email address. And when those books come out, we'll send out the e-version of them. And nice. And I'll send both books when they're both out. So.
Okay. You have a title yet?
I don't. So the book that I'm authoring myself, I have a ghostwriter that I'm working with, and really want to get through the entire body of the book before we choose a title. But I think one possibility is if you want to be a great lender, get to know Chris Haddon. That's one of them that I'm kind of contemplating. It's a little long, but we'll see.
I don't think you're allowed to use my name and likeness.
It'll be a caricature. It's not a big deal.
There we go.
But other than that, I'd love to hear from anybody that's on this podcast, especially because, it sounds like you're all interested in the lending space. Anybody wants to talk about, how we take on private money. We've done it in multiple different ways. We've got a couple of funds that we collect, raise money in. We have people that just come in and do one-off loans, but across the board, we pay our investors 9%. So
Nice.
it's been pretty steady that way, and of course secured by the real estate. So man, I think that's about it. Probably running out of time. So
Well, next time I'll make sure to invite Jeff to the podcast instead of you, Derek. But we certainly appreciate you coming out.
Chris, don't let that happen. Ridiculous.
Good stuff.
We can battle it out. All right. Thanks, Derek. Everybody, thanks again for watching this episode of the Private Lenders Podcast. Make sure to check out hardmoneymastermind.com if you have not created your free account. And we'll see everybody next week. Thanks.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you'd enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community